US coin melt arbitrage. US coin melt arbitrage happened because coins have two values. One is face value, which is the number printed on the coin. The other is metal value, which is the value of the metal inside the coin. In the mid 2000s, metal prices went up a lot, especially copper, nickel, and zinc. These metals are sold on commodity markets, which are large markets where raw materials are traded. At one point, the metal inside pennies and nickels was worth more than the coin itself. This meant people could melt the coin and sell the metal as scrap for more money than spending the coin. Scrap buyers pay for metal by weight, not by face value. People started saving huge amounts of coins and melting them instead of using them. This caused fewer coins to stay in circulation, which threatened the cash system. The US government responded by making it illegal to melt or export pennies and nickels and added heavy fines. This forced the coin value and metal value back into balance and ended the opportunity. ACH refund loop. The ACH refund loop worked because the ACH system is slow. An ACH stands for Automated Clearinghouse, and it is the system used for most bank transfers in the United States. ACH payments can take several days to fully finish. During that time, the payment shows as pending, which means it has been requested but not completed. Some businesses treated pending payments as real money and issued refunds before the transfer was finished. Refunds send out real cleared money. If the original ACH payment later failed because the sender had no money or the bank rejected it, the refund still stayed. This meant money left the business even though no money ever arrived. Once banks required payments to fully clear before refunds and added better checks. The Chase ATM glitch was not really a glitch, but a misunderstanding of how checks work. Checks take time to verify, and banks sometimes make part of a deposit temporarily available to customers. This temporary availability does not mean the check is real. People deposited bad or fake checks and then withdrew cash before the bank finished checking the deposit. When the check failed, the account went negative, which means the withdrawn cash became debt. Chase reversed transactions, froze accounts, and demanded repayment. Many people ended up owing large amounts of money. This showed that it was not free money, but abuse of delayed check verification. USPS money order laundering. USPS money order laundering worked because money orders are prepaid paper payment slips similar to checks. USPS money orders were trusted because they are issued by the government. Criminals bought money orders using stolen cards, fake checks, or illegal cash. Once purchased, the money orders looked clean and could be deposited into banks or used to buy things. This made illegal money appear legitimate. This process is called laundering, which means hiding where money really came from. Over time, limits were added, identity checks were required, and tracking improved. Once money orders became traceable, this method stopped working. Online game currency duplication. Many online games have in-game currency that can be traded or sold for real money. In the early 2000s, some games had glitches that let players duplicate currency. One example is when a player would send virtual coins or items to another account and then perform a rollback or log out during the transfer. The game sometimes credited both accounts with the same currency, effectively creating money out of nothing. Some players sold these duplicated items for real money. This worked because the game servers did not immediately reconcile account changes or check for duplicates. Once developers noticed, they fixed the server logic and added transaction validation to prevent the same item from being credited twice. This is an example of how timing and system trust can create money-like glitches, even in virtual economies. Car insurance payout timing exploit. A car insurance payout timing exploit happened because insurance companies often pay claims in stages instead of all at once. When a car was damaged, the insurance company would first estimate the value of the damage and send an initial payout based on that estimate. This money was sent before repairs were completed. The insurance company expected the money to be used to fix the car and planned to adjust the final payout later if needed. Some people exploited this timing by reporting damage, getting the initial payout, and then not repairing the car or repairing it cheaply while keeping the remaining money. In some cases, the same damage was later reported again after the policy renewed or to a different insurer if coverage changed. Because insurers relied on photos, estimates, and paperwork, instead of real-time physical checks, the same damage could appear new on paper. This worked because insurance systems trusted reported information and did not always share claim history across companies. Once insurers added shared claim databases, vehicle history reports, better inspections, and payout controls, the exploit became much harder to pull off. Store refund receipt reuse myth. The store refund receipt reuse myth became popular because of how basic retail systems used to work. In the past, many stores processed refunds manually using printed receipts and did not always track them digitally in real time. People noticed that if a receipt was not marked or scanned into a system, it could sometimes be reused. The idea was that someone could return an item, get a refund, keep the receipt, and then try to return the same item again at a different location. The Robinhood Infinite Money Glitch. The Robinhood Infinite Money Glitch happened because of how Robinhood calculated account value. Robinhood allowed users to borrow money for trading through a feature called Robinhood Gold. The amount you could borrow depended on your account value, which is called buying power. Buying power means how much you are allowed to trade with. Users sold covered calls, which are options contracts that give upfront cash. This cash is not guaranteed profit because the trade is not finished. Real owned money called equity. This made accounts look bigger than they actually were. Bigger accounts allowed more borrowing allowed more options selling. This created a loop where borrowed money and temporary credits kept stacking. No real profit was created, only risk and debt. When the market moved the wrong way, losses became massive. Robinhood fixed the system, restricted options trading, and shut the exploit down. Mt. Gox Bitcoin Ghost Deposits. Gox Bitcoin Ghost Deposits happened because of how Bitcoin transactions are confirmed. Bitcoin transfers must be confirmed on the blockchain, and confirmations prove that a transaction is final. Gox credited user balances before full confirmation. The exchange relied on transaction IDs instead of confirmation counts. A flaw called transaction malleability allowed transaction IDs to change even though the transaction still existed, while the blockchain still processed it. This caused duplicate credits and allowed users to withdraw more Bitcoin than they deposited. Over time, the losses added up. Hundreds of thousands of Bitcoin went missing, and Mt. Gox collapsed as a result. The PayPal reversal exploit. The PayPal reversal exploit worked because PayPal used to trust transactions too quickly. When someone sent money, PayPal showed it as real money immediately, even though the banks had not finished checking if the money actually existed. This checking process is called clearing, and it can take days. At the same time, PayPal allowed people to create many accounts with very weak identity checks. So one person could control multiple accounts without the system linking them together. A person would send money from one account to another, and because PayPal did not lock the funds, the receiving account could move the money instantly. The final problem was PayPal's refund system, which often refunded the sender first if they claimed the payment was a mistake or fraud. PayPal did this before taking the money back from the receiving account. By the time PayPal tried to recover the money, it was already gone. The middle account went negative, which means it owed PayPal money. Those accounts were usually abandoned because they were created with fake details. The sender got their money back, the final account kept the money, and PayPal took the loss until it delayed access to funds linked accounts together and enforced debt collection, which ended the exploit.